Now, analysts at Cardinal Stone say they expect investors at the Nigerian stock market to build on the profit-taking momentum as more companies release their first quarter earnings. Kayode Eseyin, lead consumer goods and agriculture sector research at Cardinal Stone, joins me to discuss the outlook for the market this month and for the quarter. Kayode, thank you so much. Pleasure to have you on the show with us.
Thank you very much for having me.
We're still seeing good, strong Q1 earnings coming in from across the sectors. We've seen a couple so far, ETI, Okomo Oil, and across the banks. But talk to which names come to mind for you where you would say the numbers were quite impressive?
I think for me, the consumer goods were the pick of the lot, particularly going by how they performed in terms of operations, not just operations, especially when you compare the bottom line with what happened last year. Last year, quite a number of these companies were beat down due to the FX losses that they reported within the review period. And that's largely because a lot of them rely extensively on imports, raw materials to manufacture their end products. But the currency moved against them, and some of them had large FX liabilities positions, which they had to revalue at the current exchange rate. But like going into in the current year, what we are seeing is that we have a more stable forecast and expectation for the currency in 2025, and yet today the devaluation we've seen is just a slight dip, at least compared to last year. And so what that meant was that a lot of these consumer goods were able to focus on core operations and deliver strong operating results.
And so for the overall or the general business environment for this year going forward, do you think that investors are bullish in terms of how these companies are going to perform? Taking key metrics into consideration: inflation, GDP growth, revenues from the federal government, etc.
Yes. I think we are quite bullish on FMCG names, particularly due to the development we have seen both on the inflation side of things. Even before, if you were to look at it from the perspective of rebasing, and even before rebasing, what we were saying was that inflation was starting to trend lower, and that bodes well for consumer wallets and consumer purchasing power. And then even post rebasing, we also saw consistent trend in reduction in inflation, though the most recent data from the MBS reviewed an uptick. That's largely due to the fact that energy prices were a bit volatile in the last month, but the expectation still remains that for the rest of the year, inflation will likely bode well, for consumer and purchasing wallets.
But what about the banks? I guess we know the story of the banks. Interest income, we've seen that high. Income from their digital platforms and all of that. But what else did you see in those numbers?
So the banks particularly benefited from this high inflationary environment, likely due to the fact that they were able to rely on the increase in interest expense or higher yield environment to report higher yields. And so that's why we saw quite an impressive 2024 result. And then when you add on top that the devaluation, I think the banks were on the other side of the losses that the consumer goods reported. They were long dollars versus short dollars that we saw in the consumer goods. And so banks were able to report significantly higher earnings on those two fronts. But going into 2025, though banks are unlikely to book large FX gains due to the fact that, like I said, currency has been quite stable, but quite a number of them, Zenith, Access, have been able to still report earnings growth, even despite the reduction in FX gains, largely due to the interest expense leg of things.
Now, by this time last year, the market was already doing upwards of about 30% or so. But at this time now, this period, it's obviously way lower. But looking at these numbers, Q1, and even across sectors that didn't, previously in the last year or two, didn't do so well, especially among the fast-moving consumer goods and names, could things significantly change in terms of the sentiment and on feeding into the broader index? Could we see significant?
Yes. We expect like you said, year-to-date performance, at least compared to this time last year, was a bit tame. And I think the reason for that was the market was in the need of a direction, because going into the new year, there was a lot of uncertainty about whether the consumer goods would really recover, though we maintained our optimistic outlook about the consumer goods because we saw that the worst was over for them. And then people were not so sure as to how the banks would perform. High base from last year, would they be able to repeat such performance, or would there be pullback in earnings? And so the Q1 earnings just has provided clarity to everybody. So at least now we're starting to see a sense of where we expect the dice to roll. Consumer goods did well, banks still did well, and industrial goods quite across the board.
Right.
Oil palm producers, almost everyone had a story to tell in Q1, and that just goes to show that we are likely to see the bullish sentiments return into the market in the current.
Right, and you did mention in your report that you're expecting the foreign portfolio investors to also drive sentiment and drive perhaps a bull run, hopefully, going forward. But talk to us about, because analysts that I've spoken to in the last couple of weeks and even months, yes, we've seen the presence of FPIs, but I mean, the impression that I've gotten is that they weren't exactly in large numbers because of of course, the attractive fixed income yields. But you are pointing to the fact that we may be seeing a larger number than is being reported.
So going by the NGX most recent number, that's for March 2025, what we saw was quite interesting, because I think that was the first time since November 2019, if memory serves, that we saw FPI participation in the markets higher than local participation. And so that's an indication that maybe the FPIs have really returned to the market. And the main drivers for that will be two reasons. From my own perspective, first of all, if you look at the NGX market, the Nigerian Stock Exchange, NGX ASI index rather, it looks to be cheap when compared with its own historical means and even EMA pairs. For example, from a PE standpoint, the NGX currently is about 7x versus what it was trading even 2024 close, 2023 close, around. There's always been hovering around 10 times earnings, but currently they are trading at deep discounts. And it's even more interesting when you consider the fact that margins and ROE metrics have improved significantly from 2024, 2023 numbers due to the earnings boom we are talking about. And then also, it starts to look, just based on that alone, starting to look that the NGX maybe might start to look too cheap to ignore for some of these FPIs. And then when you add on top the fact that Nigeria seems to be a bit insulated from the geopolitical tensions or tariff wars that we are starting to see. If you compare Nigeria with other EMA pairs, you would realize that quite a number of these their listed stocks in their indices are very export dependent, and that means that some of them will be affected by protectionism in developed markets like US and EU. But Nigerian stocks per se, particularly, they don't rely so much on exports. Quite a number of them do, but export still is not the majority of their earnings. So Nigeria, from that standpoint alone, Nigerian equities appear to be very defensive to some FPIs. And we think a combination of these two reasons is why we're starting to see some inflows in that space.
Now, for the oil and gas sector, I'm not sure if it's a different story, because you and I have been watching oil prices significantly come down. Today, Brent is just over $61 per barrel. We know that last year was a good year for the oil sector. And we saw, of course, names, investors rallying around these stocks. But could that change going forward with what we're seeing, lower oil prices and all the geopolitical
oil
issues?
Prices would continue to be the major driver of earnings in the oil and gas index sector. If you look at Aradel's earnings and even that of Seplat, we saw the impact of lower oil prices. For example, particularly Seplat, the expectation was following the closure of the acquisition, there would be an earnings shot. And we did see an earnings shot, but I think they were also impacted significantly by lower oil prices. And so as long as that hangover remains across the industry, we're likely to see some bearish on that one. And that's why if you check on a year-to-date basis, the oil and gas sectors haven't particularly performed so well. I think it's one of the weakest in the indexes on the exchange. So just as long as though interestingly, oil prices are not impacted directly. I think there's an exception for oil prices according to Donald Trump's tariff that he imposed. But then again, the fact that it ties into investor wallets, consumer demand, and a lot of perception just means that the entire oil and gas industry is looking a bit under the weather for the time being.
All right, Kayode, we'll leave it there. Thank you so much for talking to us. We appreciate your time today. Kayode Eseyin, lead consumer goods and agriculture sector research at Cardinal Stone, looking at the outlook for trading this month at Nigeria's stock market.